Brian Beaulieu, CEO and Chief Economist of ITR Economics. Today is April 21st, 2023, and thank you for joining us for this edition of FedWatch. There's three things I want to highlight in this brief message. One is the Chicago Federal Reserve National Financial Conditions Index for March is out. And according to the Fed's data, the Chicago Fed's data, they report that financial conditions are better than average right now, looser than average. And you know, for them, it's binary. If it's a negative number, it's a better than average situation. If it's a positive number, it means credit conditions are getting tighter, financial conditions are deteriorating. So it's binary for them. What we did is we looked at the trend. And the trend, while it still is a negative number, and therefore, from their view, better than average situation, it isn't, folks. When we're at this level, it's very much like where we were in the 2000-2001 business cycle, and that's one of the cycles that we've been modeling this one after. They're not easy, and it bothers me that the Fed would think credit conditions and overall financial conditions are better than average, given how tight credit has become out there, especially with bank stocks going down and the two bank failures and the ripple effect that is having. We're not quite as bad with that index as we were in the 1990-91 cycle, which was worse than the 2000-2001 cycle, but we're keeping a close eye on this. Clearly, the financial conditions are deteriorating out there. That trend is pretty clear. Second point I wanted to hit upon, what's new, is the Beige Book is out, and that comes out 8 times a year, and that's the Federal Reserve's analysis of the different bank districts and how economic conditions are faring overall. No major surprises there. They see conditions fairly stable, maybe weakening a little bit over the last couple of weeks. I think the biggest news there was they saw non-labor prices and freight prices coming down appreciably, and in some cases significantly. And we're seeing the freight clearly amongst our client base. And it's the non-labor that stuck with me. You know, the producer price index, which tends to lead the consumer price index, is coming down, and the intermediate material price index is already showing some signs of deflation. But 42% of the producer price index is driven by services other than trade, which means retail sales and warehousing services. It's driven by the cost of physicians, accountants, attorneys, IT professionals, et cetera. And they're going to be very sticky with their prices on the way down. I don't see them cutting their wages. So that tells me that we're probably on track, that the CPI is coming down, but it's not going to go back down to that zero mark that we are used to seeing over the last 3 to 4 business cycles. And finally, I wanted to talk about job openings, because in the Beige Book, they had mentioned that job openings were varied actually across the districts, but generally stable conditions. When we look at the job openings trend, it's very clear to us that that is in a downward trend, and within a couple of months, we're going to be below the pre-COVID trend level. So the pendulum will have swung in a business cycle way, even adjusted for COVID, into a period of cautious behavior. Businesses, we're seeing more layoffs, obviously, but I think beneath the radar surface, we're seeing attrition taking place, and we're not refilling those jobs unless they're really key positions. And that's okay. That's a much better way to do it, through the attrition rather than through the layoffs at this juncture of the cycle. But it is something we're keeping a very close eye on. Right now, there are some other threats to the business cycle stemming from these high interest rates, the commercial real estate market being one of them. We're going to be recording a trends talk on the commercial real estate market. So if you want to, flip over to that part of what we bring to you, and you can learn more about it there. Suffice it to say, it's limited right now to the office space, and that's no big surprise to anybody, but it is a weakness in the financial system that we're keeping a close eye on. Thank you for joining me for this edition of FedWatch. Nothing major except for credit conditions getting tighter, beige book, supporting what we're seeing in terms of labor attrition taking place and some more layoffs. I think it's a good time to be acquiring talent if you are in a good position in the business cycle. Thanks again for joining us. See you next week.